when US equities, Japanese stocks, Japanese bonds, Bitcoin, and even gold are all facing heavy sell-offs simultaneously. Even if you have absolutely no interest in investing or finance, I urge you to pay close attention to this video. Why? Because an army marches on its stomach, and in this case, the supply lines represent the smart money in the market. Right now, that capital is signaling loud and clear that our wealth is evaporating. Hello everyone, welcome to Stewardship Finance Academy. Money is energy. It must move continuously to survive. For example, traditionally, if volatility hits the US stock market, capital might rotate out of stocks and into US Treasury bonds. If treasuries face headwinds, funds might flee to gold. Usually, the asset class losing capital sees prices plummet, while the safe haven absorbing that capital sees prices soar. But look at the current landscape. Risky assets have fallen, and safe haven assets have also fallen. No matter where you park your cash right now, the risk of devaluation is severe. It appears the money has indeed been withdrawn, but it hasn't been transferred elsewhere. It has simply evaporated. Why is this happening? Is the AI bubble finally bursting? Consider this. NVIDIA, the undisputed leader in AI, released an earnings report that should have silenced all doubts. They earned 22% more this quarter than the last. With financials like that, how could anyone call AI a bubble? NVIDIA's stock price plummeted that very day, correcting by nearly 20% recently. If you believe NVIDIA is an isolated case, look closer. Meta Platforms has seen corrections of up to 26%. Microsoft has dipped by 16%. Palantir Technologies has dropped by 28%. And Oracle Corporation has plunged by a staggering 46%. You will notice that these were among the top-performing AI-linked companies earlier this year. Now, in a flash, they have all corrected by an average of over 20%. If you had invested $1 million, $200,000 would be gone. And you will find that these plummeting giants share one common denominator. They are all deeply tied to one entity, OpenAI. This is where it gets strange. I had to analyze NVIDIA's report. And do you know what happened? I was instantly transported back to the year 2000, looking at a company called Lucent Technologies. Lucent doesn't appear in NVIDIA's report, and few in 2025 talk about it. But in 2000, Lucent held the exact same position NVIDIA holds today. If you wanted to mine for gold in San Francisco during the rush, you needed a shovel. Today, the world needs NVIDIA chips to develop AI. NVIDIA sells the shovels for the AI gold rush. Back in 2000, the world needed Lucent's equipment to build the internet. Lucent sold the shovels for the .com gold mine. So why has Lucent faded from history? Because its stock price collapsed from $84 to less than 55 cents. People forget. The myth of invincibility fades. Does Lucent's history mean NVIDIA is destined to follow the same path? Not necessarily. But what if they not only occupied the same market position, but also employed nearly identical financial mechanics? And just when I thought this was isolated to US equities, Bitcoin plummeted by 36%. Gold, despite a 6% rebound, still faced an 11% correction. Hong Kong and Chinese markets fell. Japanese stocks and bonds fell. This raises the critical question. If this were simply an AI bubble, shouldn't the damage be contained to the US tech sector? Yet most asset classes are declining globally. What is happening? If I told you the purchasing power of the dollar is being strategically diluted, you might think I'm exaggerating.
I am very exaggerating.
I am not suggesting the dollar will collapse overnight. I am suggesting that American capital may be executing a strategy to consolidate global dollars before rendering paper currency obsolete. If you want to avoid being collateral damage in this wealth transfer, or better yet, capitalize on it to transcend social classes, make sure to subscribe to this channel. I will be providing critical updates as this situation unfolds. If you want to ensure you don't lose this information, like this video so it saves to your playlist for future reference. And back to the data. NVID's financial report shows profits are 22% higher. Does high profit prove there is no bubble? Many argue, of course. Any company developing AI needs NVIDIA chips. If these AI companies weren't solvent, they wouldn't keep buying. But does NVIDIA's profit prove the entire AI industry is profitable? Let's look at the facts. NVIDIA, the shovel seller, is netting over $20 billion a quarter. But what about OpenAI, the vanguard of AI development? Projections suggest OpenAI could lose $9.3 billion this year. Next year, losses could widen, and an IPO seems unlikely. If you can't see the problem, shift your perspective. If the shovel seller is making a fortune, does that mean the gold miner is rich? The reality is the shovel sellers are earning more than all the gold miners combined. This means you, the gold miner, might be losing money while spending double to buy equipment, enriching the supplier further. This disconnect is the definition of a bubble. As the shovel seller, you don't care if the miner finds gold. You only care that they buy the shovel. You don't need them to succeed. You only need to convince them that success is possible. The more money the shovel seller makes while the miners bleed cash, the larger the bubble actually is. OpenAI's losses prove that NVIDIA's record-breaking profits are actually a warning sign, not a safety signal. NVIDIA's high profits simply mean chips are selling. Whether AI generates real-world value is a separate issue. Before 2008, demand for mortgages was massive. That didn't prove the real estate market was healthy. It proved it was overheating. NVIDIA's stock price rise and fall is a symptom, not the cause. But there is a smoking gun in the financials that mirrors the Lucent collapse almost perfectly. Lucent's strategy back then involved lending money to customers so they could buy Lucent products. In finance, we call this aggressive accounts receivable financing. If customers lacked cash, no problem. Lucent provided the loan. This made sales figures skyrocket and financial reports look pristine. But in reality, they were shipping products without collecting actual cash. You only get paid if the customer succeeds. That was the dot-com bubble. Look at AI today. OpenAI reportedly had limited liquid cash, yet signed a massive investment agreement. Reports suggest NVIDIA invested in OpenAI with the stipulation that the funds be used to purchase their chips. OpenAI then signed cloud service agreements with Oracle Corporation. Oracle, in turn, could use future revenue promises from OpenAI as collateral to buy NVIDIA chips. The money moves in a circle and ends up back at NVIDIA. Everyone books a sale, and stock prices soar. But NVIDIA's recent report reveals the cracks in this foundation. NVIDIA sold $57 billion in chips, yet accounts receivable ballooned to $33 billion. That implies that over half the goods sold were essentially on credit. The repayment timeline is stretching out. Lucent's customers took up to 64 days to pay because they weren't generating profit from the equipment they bought. NVIDIA's credit periods have extended from 48 days to 50, and now 53 days. Just like Lucent, NVIDIA claims high demand, yet we see a contradiction. Inventory is skyrocketing. NVIDIA's inventory has jumped from $10 billion to $20 billion, more than doubling. If chips are indispensable and in short supply, why are they piling up in warehouses? It suggests downstream AI companies may be struggling to take delivery or pay. Industry reports, and even comments attributed to Microsoft's Satya Nadella, suggest that while they have the card's GPUs, they lack the power infrastructure to run them. The GPUs are gathering dust. Developers are burning cash buying hardware they can't fully utilize, meaning they aren't generating revenue. Meanwhile, suppliers are waiting for payment. This is a classic domino setup. If one entity fails, the debt owed to upstream suppliers turns into bad debt. This is the Lucent trajectory, lending to customers who cannot pay, leading to a cash flow crisis. The AI bubble's fate depends on whether companies like OpenAI can monetize, not on whether NVIDIA can sell chips on credit. The drop in NVIDIA, Oracle, and Palantir stocks is just a consequence of the bubble deflating. The 2008 crash happened because homeowners couldn't pay mortgages. The AI crash will happen if developers can't monetize their compute. We need to watch OpenAI closely. But there is another domino already falling, the rental price of GPU computing power. I warned about this previously. Tech giants like Meta are often using financing structures involving shadow banks to fund data centers, planning to rent them out at a premium. These revenue streams are then packaged into financial products sold to pension funds and insurance companies. This means your retirement money might be funding these data centers. The model only works if rental prices stay high. But look at the data. In August, the rental price for an H100 chip was around $3.30 per hour. Now, it has dropped to approximately $2. That is a 40% drop in 3 months. Data centers built on projected high returns are now opening their doors to a collapsed rental market. A 3-year ROI timeline has now stretched to 5 years or more. If this market implodes, it affects you directly. Even if you don't trade stocks, your pension fund and insurance provider likely hold these financial products. During the 2000 and 2008 crashes, people who never bought a stock in their lives still lost their jobs and saw their savings stagnate. It happened in 2000, 2008, and the 2020 pandemic. As we look toward 2025, the cycle accelerates. Are you prepared to let the economy decide your fate, or will you take control? Our community avoided losses during this recent correction because we shifted allocation to gold and silver, capturing historic gains. We play a guerrilla warfare style of investing. Unlike Warren Buffett, who sells a year early, we aim to be just 1 second ahead. We surf the bubble and exit before the crash. If you want to learn this system, we have condensed 3 months of research into our stock investment masterclass. Usually this is premium content, but for our subscribers, we are offering it as a public service for free. Click the link in the description to secure your spot. Don't wait until the crisis hits. So, what is the macro endgame? If AI giants in the US government need to keep this bubble inflated, they need liquidity. OpenAI's CFO has even reportedly suggested government-backed loans for infrastructure. This requires massive capital injection. But with the US government spending $600 billion a month in Treasury bond demand week, where does the money come from? The Federal Reserve's overnight reverse repurchase agreements, essentially the market's emergency piggy bank, are draining towards zero. Bank reserves are approaching the regulatory red line. The traditional liquidity pumps are running dry. To sustain the AI bubble in the banking system, we are seeing a shift. Other asset classes are being pressured to force capital back into U.S. banks and treasuries. Russia selling gold, the yen carry trade unwinding, and taxes on crypto are all mechanisms to funnel liquidity back to the dollar. But that isn't enough to absorb the debt issuance. This leads to the Bitcoin factor. Reports indicate the U.S. government, through seizures and legal actions against individuals like Chen Zi and Kian Zimin, has amassed a massive Bitcoin stockpile, potentially controlling over 400,000 BTC directly. When combined with holdings by ETFs and U.S.-based entities like BlackRock, the U.S. effectively controls a significant portion of the global supply. Why did the world accept the dollar initially? Because it was backed by the largest gold reserves. Now, the U.S. holds the gold and the Bitcoin. This paves the way for stablecoins. Stablecoins represent a new money printing mechanism. If banks buy U.S. treasuries to back their stablecoins, they earn interest on the debt while the public uses the tokens for payment. This creates limitless demand for U.S. debt. Imagine a near future where you pay at Starbucks or Ralph Lauren using a USD-pegged stablecoin via QR code. We're essentially swapping physical dollars for digital tokens backed by treasuries. This solves the U.S. cash shortage. The restrictions on banks holding treasuries are already being eased to facilitate this. Initially, people doubted credit cards. People called Bitcoin a scam until it hit $100,000. If major retailers like Amazon or Walmart offer discounts for stablecoin payments, mass adoption will follow. This is the monetary revolution. And historically, every monetary revolution is accompanied by an asset price reset. Warren Buffett is waiting with cash. Short sellers are waiting. We are waiting. The train is about to derail. You must get off first. Check your principle. If you want to master these skills, join the free training via the link below. Let's discuss this rationally in the comments. I will see you in the next video for more insights on achieving financial freedom. Subscribe, share, and stay safe. See you in the next video.